Happy Friday. I'm hoping you guys are all having a nice snowy winter day in the great state of Idaho. Hey, I got a few things for you. All are spectacular. So let's get right into it. So the first thing today is a new program, not necessarily a new program, but a program that's been improved. So Fannie Mae and Freddie Mac have a standard program called Home Ready and Home Possible, and then Idaho Housing has their program called HFA. And what it does is it allows medium to lower income people to get into houses at a reduced interest rate. Well, what's happened is Fannie Mae and Freddie Mac have increased that amount. So typically, the borrowers in this category had to have an average medium income of about $57,000 or less. They've actually increased that up to $87,000. This is pretty spectacular because Fannie Mae and Freddie Mac says it's going to open up this program to about 22% more borrowers. And basically what it does is it prevents the interest rate from having what's called a loan level pricing adjustment for credit scores. So in the case I have here below, a 640 FICO score today would, with 5% down, would have an interest rate of 8.375. But come Monday, we're hoping it's Monday that they roll this officially out, that 640 FICO score would be 7.25. So basically what's going to happen is it doesn't matter what your FICO score is. You can have a 620 or you can have an 800 on this program, and you're all going to have the same interest rate. This is pretty spectacular for the lower FICO scores. The other thing is it's based off of not household income, but application income. So if the husband makes $87,000 per year and the wife makes $87,000 a year, but we just need the husband's income to qualify, we can put the wife on the application, just not put her income on there, qualified on application income of $87,000, and we get them. So this is a really, really nice program that originally was good, and now they just made it better. Next, lenders are adjusting stuff, and we have a lender that's rolling out home equity lines of credit for investors. This is kind of a unique program. We've already had home equity lines of credit for primary residents. We've had them for secondary homes, but now we have them for investors. So we can go up to 80% loan to, or 70% loan to value. It will be a draw for 5 years. It is a fixed rate mortgage, and they can have a 5 to a 30-year term on it. So what can they do with it? Well, they can pretty much cash out anything, all of the equity they have, and do pretty much anything they want with it, with the exception of going to Oregon and buying pot. Can't use it for illegal activities in the state of Idaho. So they can cash out their equity that they've been sitting on and go purchase another house. They can cash out the equity and go do some fix-ups, or they can cash out the equity, kind of hold on to it and wait for that great house to come up. As a realtor, this is a great opportunity for you to get out in front of your investors and say, hey, home prices are coming down, sellers are paying lots of concessions, and we can utilize some of that equity in your existing houses to purchase another house. Pretty nice little program. So along with that, buydowns are coming out. Buydowns are actually a good portion of our business right now because they actually really help a borrower get into a house and kind of overcome that interest rate obstacle they have. Now, you can see the various different buydowns. We have the 3-2-1, the 2-1, the 1-1, and the 1-0. Everyone has its little pros and cons on it. But the benefit for the borrower is for the first X years, if it's 3-2-1, that payment is a lot less. Now, we still have to qualify the borrower on the fully amortized payment, but it kind of softens the blow for the first few years. For the realtor, it benefits if you're the buyer's agent. It kind of overcomes that obstacle of, oh my God, interest rates are high. And then for a listing agent, rather than taking a price reduction, offer these buydowns, and maybe the buyers can be focused in on your particular listing. So here's a couple examples of some buydowns that I have. Both are $450,000 purchase price. One's got a 5%, one's got a 10%, one's a 2-1 buy down, one's a 3-2-1 buy down. But you can see on a 2-1 buy down here that your first year interest rate, your interest rate starts at 7.2, but your first year it's down to 5.2, which means the seller concessions are going to subsidize by $554 per month. If you look at the 3-2-1 buy down, there is a little caveat in this one because if the borrower is only putting 3 or 5% or basically less than 10% down, you can only use 3% concessions. But if they do 10% down or they go FHA, VA, or USDA, you can pretty much use all the concessions you can. So in this situation, it's a $450,000 house, 10% down. The first year interest rate is 4.2%, which means the seller is subsidizing by $768,000. And then the second year and third year. Now, a lot of people are asking, well, if rates go down next year, what happens to that money? So let's take the 3-2-1 buy down. And let's say after a year, we've used $9,000. So we've got what, $9,000 basically left over of interest. If the borrower refinances, so let's say interest rates drop, and the borrower refinances, that remaining balance actually goes credited towards their principal amount. So their payoff is less. Also, if they sell, that remaining balance goes against the principal and they have less owed on the house. So it actually is a pretty nice win-win situation. We do anticipate rates hopefully being less next year. And with that, let's talk a brief thing about rates. Unemployment numbers came out. The clickbait says unemployment numbers came out great, but when you really drill down to it, unemployment numbers were not that great. Unemployment went from 3.5 to 3.7%. And they said they created, I forgot, 200 and some odd thousand jobs, but the problem is the majority of those jobs were in the low wage range. We actually lost a significant portion of jobs between the ages of 40 to 65, and those are the higher paying jobs. So we're seeing higher paying jobs being laid off right now. Next week is a big, big week because we have the consumer price index coming out on Thursday. If the consumer price index shows inflation is decreasing, we will actually probably have a rally in the stock market, we'll have a rally in the bond market, and interest rates will go down. If we replace the year-over-year number with a higher, all bets are off. It's not going to be a pretty sight for interest rates. We will probably see them roll into the 8s and start heading for the 9s. Hey, with that being said, thank you very much. I appreciate your business as always. Have a great day. And as always, go Broncos.